By March 2000, Cisco Systems had reached a valuation of $550 billion. That number pushed them past Microsoft to become the most valuable company on the planet. Then the dot-com bubble popped. Cisco's stock crashed, erasing 80% of its value in a matter of months. Investors who bought at the peak had to wait exactly 25 years, until December 2025, just for the share price to reach break-even. This chart shows the stark difference between the stock ticker and the actual business. While the share price flatlined for decades, the company's internal financials climbed consistently. In 2002, they brought in $18 billion in revenue. By 2025, that number had reached $56 billion. Now, the massive data requirements of artificial intelligence are forcing networks to expand, sending that steady growth curve into a steep acceleration. The year 2000 hype cycle distracted the market from a very simple reality. Cisco survived the crash because the internet physically cannot function without their hardware. That hardware consists primarily of routers and switches, the physical boxes and cables that direct data traffic from one network to another. Looking at their income, 77% comes directly from selling physical products, with the remaining 23% from services. Drilling into products reveals the core engine. Networking brought in $8.8 billion recently, a 25% increase. Security, collaboration, and observability are much smaller. Despite years trying to pivot into software and cybersecurity, physical networking equipment still pays the bills. But the real strength of this hardware lies in the people who operate it. Millions of IT engineers spend years studying for CCNA and CCNP certifications, effectively training themselves to exclusively manage Cisco's proprietary systems. If a corporation wants to switch to a competitor's hardware, they don't just buy new servers. They have to retrain or replace their entire IT department. Cisco leverages that inertia. Once the hardware is installed and the engineers are locked in, they collect $31 billion in annualized recurring software revenue. They are applying that exact strategy to hyperscale data centers, developing custom chips and specialized optics for the extreme demands of AI clusters. They engineered an ecosystem where ripping out their hardware costs a company significantly more money than simply paying the annual subscription fees. This pipeline model shows how to read Cisco's financial future. You have recognized revenue flowing out of the pipe, which is a lagging indicator of past sales, and product orders flowing in, which acts as a leading indicator of future growth. On the output side, their third quarter of 2026 hit a record $15.8 billion in revenue, putting them on track for $63 billion for the full year. That represents their sharpest acceleration in a decade. But to see where the company is headed, look at the inputs. Total product orders are up 35% year over year. The artificial intelligence backlog is driving that surge. AI infrastructure orders jumped from $2 billion in 2025 to $5.3 billion booked today, with management raising their target to $9 billion by the end of 2026. Tech giants are translating their AI ambitions into legally binding contracts for physical network upgrades. However, this rapid build-out carries specific risks. Companies like Google and Amazon have the engineering resources to design their own network hardware from scratch, which would cut external suppliers out of the loop entirely. Cisco also faces intense competition from rivals like Arista Networks. And if you strip away those massive AI orders, growth in their traditional product lines sits at a very modest 4 to 19%. The optimistic view points to a genuine AI demand inflection, an ongoing refresh cycle for physical campus hardware, and that massive $31 billion recurring revenue floor providing a safety net. But this chart illustrates the core problem for new investors. The stock has doubled from its recent lows and is now trading at 36 times its trailing earnings, a steep premium over its historical average that assumes flawless execution going forward. 25 years after the dot-com crash, the market has to answer a familiar question. Does this premium valuation accurately reflect the true worth of the internet's plumbing, or are investors paying year 2000 prices for a year 2026 reality?